Hello and welcome to Macro Matters, the economics and politics podcast from Aberdeen Standard Investments. My name is Paul Diggle, and along with my co-host Stephanie Kelly, we're guiding you through the macroeconomic and political themes which are driving global markets. And today we're talking about the US labour market and the Federal Reserve. Recent US jobs data have been on the disappointing side, at least relative to the size of the shortfall with the pre-pandemic labour market. In particular, worker shortages are evident in a number of sectors. So we're going to talk today about how worrying or not these shortages are, how permanent or temporary they are, and what they mean for wages and inflation. And then we're going to discuss what all that means for monetary policy and the Federal Reserve. They've sounded a bit more hawkish recently. Should markets worry about the prospects of Fed QE tapering and eventual rate rises? So joining me in this discussion are Kathy Bostjancic, Chief US Financial Economist at Oxford Economics, the global macroeconomic research firm. And I've always found Kathy a very insightful observer of the US economy and the central bank. So I'm very happy to be joined by her today. And we also have James McCann, Deputy Chief Economist here at Aberdeen Standard Investments and our in-house US economics expert and Fed watcher. James and Kathy, welcome to the podcast.
Thank you, Paul. Happy to be here.
Thanks, Paul.
So Kathy, you're based in New York. James, you're in Boston in Massachusetts. For our listeners, especially outside the US, tell us, Kathy, what is life like in New York at the moment? What is the state of lockdown or easing?
Yeah, so things are starting to get back to more of a normal state. And actually, effective on Friday, the state of emergency ended here in New York. So that's quite a big deal. You still, if you're unvaccinated, have to wear a mask. And if we're traveling on public transportation, even if you're vaccinated, you're required to wear a mask. But otherwise, people are populating the restaurants and shopping, and things are getting back to normal.
Great. And James, are you getting out in the shops, in the restaurants yourself?
Yeah, I mean, it's strange to go back. We've obviously got the European Championships being shown over here and got out to a couple of games, and being in busy sports bars with lots of people without masks, sort of chanting and cheering. It feels really odd. I take some comfort that Massachusetts has one of the highest vaccination rates, so it does give that sense of security. But it's definitely an adjustment going back to those sorts of interactions.
It's a big change, isn't it? But a change for the better, I think. So let's get into our main topic then, our first topic, which is the US labour market. Kathy, some of the recent labour market prints, the non-farm payrolls prints, as we've said, have been disappointing, still huge in historical terms, but not as big as we might have expected given the damage that the pandemic did to unemployment. Why are those prints actually somewhat disappointing economist expectations?
Well, I think you do have a number of people who are taking early retirement. 401ks have benefited. That's our retirement plans from higher stock prices, seeing some of that. Some people rethinking, what type of jobs they actually want to work. But I think also, it was easier. There was kind of the return of workers to their previous jobs. That was the easy part. Now what we're seeing is a process of workers finding new jobs, and that just takes longer. It's also matching the supply and demand together. Also, we have ongoing pandemic fears. Even though I mentioned things are getting back to normal, New York does stand out, I think, in compared to other parts of the country where about 70% of the population has had at least one vaccination. We have ongoing childcare issues in the U.S. Some of the childcare centers haven't been reopened. Of course, now it's summer, so children or if they were in school, are now, not, able to go to school. And there's issues even with the summer camps. There's not enough counselors to be found. And we also relied on young foreigners, right? People from abroad, from Europe, coming over to help with the counseling, and they're just not able to because of COVID. And then I think the other thing, which is very political in nature and is being debated quite vigorously, is this extended unemployment benefits. Were they too generous? What we have seen is about 26 states have decided to peel back the extended unemployment benefits, and that should happen by the end of July. And all the states by September will have stopped with the extended benefits for unemployment insurance. So we think that also will start to free up the supply of labor to help meet the demand.
Great. And James, are there good reasons to think then that those factors are all temporary in nature? How temporary are they? And when do these shortages start to ease?
I think there's good reasons to think a number of them should moderate as we go through the summer. We've been speaking about how public health responses to the pandemic have started to ease. We know that in aggregate caseloads have fallen a lot, vaccination rates are rising. So some of those concerns about going back to work because of the pandemic and those restrictions do seem to be, as we speak, sort of moderating. So we'd hope to see some signs of a boost from that. As Kathy mentioned, we've got this really interesting natural experiment with a whole bunch of states removing this supplemental unemployment insurance top up. So we'll get an early sense in those states as to the extent to which that was discouraging labor supply or not. So that'll be interesting. But even regardless, we know that factor, which has been pointed in research as a contributor, but perhaps not as large a contributor to the decline in willingness to work. So we know that that's moderating as well. So I think there should be a boost, I suppose, to labor supply, or at least some of those factors that we think might be holding back labor supply should be easing over coming months. And given that we know from the job openings data, there's a huge amount of labor demand over there, we're really hopeful and optimistic that we'll get really strong job growth over the summer. And, again, as Kathy said, part of that will be just figuring out some of those labor market matches. There probably should be some natural lag as well. So I think we're quite optimistic on the ability of some of those drags to ease as we look forward.
So a lot of these issues then, as you've both been saying, are on the supply side. It's not that the economic rebound itself is suffering or that demand is weak. Demand is incredibly strong. It's really supply bottlenecks in the labour market that have been problematic. And indeed, we've talked on a number of previous podcasts about supply bottlenecks in all sorts of sectors, but of course, labour is one of those. Kathy, I've seen some really interesting work from Oxford Economics about the sectoral mismatch between where the supply of labour is and where the demand for jobs is coming from. Could you talk about why that sectoral mismatch has opened up in the US?
Yeah, no, it's quite striking, and you see it in the sectors that were hardest hit by the pandemic. So leisure and hospitality, and even manufacturing are seeing the most severe imbalances between supply and demand, where mining, logging, information and construction sector seeing less of that. I think in the leisure and hospitality, some of those workers, is what James and I were mentioning, are concerned still about the ongoing pandemic fears. Those people have to relate more directly with the public and can't be socially distanced as much. And also they're rethinking their career or job opportunities, and also looking to see, the work is hard, but also see if they can garner higher wages. So we're seeing some of that going on as well. And maybe they want to go back to leisure and hospitality, but looking even for higher wages if it was the prior job. So a lot of that friction going on in that sector. And I can tell you just anecdotally, we did take a week off to go to a vacation out in Long Island and in the Hamptons, and there was job postings everywhere. So my two young boys were saying, look at this, job wanted. Of course, I asked if they were interested. They backed off very quickly. But you see that even in everywhere, really. It's throughout the city and this area. So I think it's going to be with us a bit, but I agree with James that over time, you're going to see that rebalancing, and the demand is so strong and businesses want to reopen. We think it's just a matter of time. And we think that eventually we recoup the whole 8 million that is still lost in terms of jobs. We recoup that throughout the year.
And Kathy, you're talking there about people taking the time to rethink the job that they want. We talk about labour shortages from the perspective of markets as being problematic. The fact that reservation wages are going up, that enhanced unemployment insurance is discouraging workers, all as threatening inflation and being a problem for the recovery. But I wonder if, from a slightly broader perspective, there's some silver linings to be taken here if people are taking the time to rethink the type of job they want, if the bargaining power of workers is improving. Are these actually positive trends under the surface once we step back from sort of narrow inflation concerns?
I think that there is that silver lining, and I think it can be positive. What we had seen, from a macro perspective, is the national income share was going more to employers than employees, and that was a trend that was going on, pre-pandemic. So maybe having that pendulum swing back for the employees is a positive thing. And as you said, especially the lower income rung workers, if they could start to garner higher wages without being mandated, that could be a positive thing for sure, and help to narrow maybe some of the income inequality, although we have a long ways to go. Of course, on the flip side, that does mean that maybe unit labor costs start to rise, right? And I know we'll talk about this a bit more, but then the question is, how does that get handled? Does that, crimp profit margins or get passed on to the consumer?
Great. Well, let's move on then to our second topic, clearly very closely related, which is monetary policy, the Federal Reserve's recent change in its dot plot and the outlook for QE and interest rates. James, at the Fed's recent meeting, I think there were two big pieces of news. The tapering discussion has been moved forward, and then the median dot plot for 2023 was put up to incorporate 2 hikes. Can you tell us what was behind those decisions?
Absolutely. Well, starting with that view among FOMC members that the start to interest rate tightening should happen a little earlier and be a little more vigorous. I think there are a couple of forces driving that. I think the first is that the FOMC as a whole is starting to see some of the risks from the pandemic ease. On the macro side, it's seen the progress on vaccinations, it's seen the decline in cases, a fuller reopening, and is feeling more confident maybe around its economic outlook. And at the same time, it's seeing inflation rise quite significantly. And while it's a view that we agree with, it thinks that that's largely transitory. It's very clear at the last meeting that it does see the risks that inflation outlook is being tilted to the upside. So in some ways, I think it just reflects a sense that some of the downside risks to the macro outlook have moderated, and they're, while not having it as their base case that there are major inflation risks, certainly they're a little concerned about that. And then the second is probably related to this concept of their average inflation target and the sense to which, how much of an inflation overshoot are they willing to tolerate? What is the look back period over that average inflation target? Should they look back over the past decade and think we've been consistently falling short of inflation? Or should they look back just over this recent crisis and think we had weak inflation for around 12 months or maybe a little more? And I think what maybe this has showed is that for a few of the FOMC members, certainly those who are factoring in the more hawkish stocks, the more hawkish projections for interest rate tightening, they're really looking back over a relatively short horizon and feeling that actually we've made up a lot of that inflation shortfall, so we shouldn't be looking to overshoot for much longer still. So I think a combination, the change in how they view the macro outlook and the risks around that, but also maybe some new information on the Fed's reaction function, certainly part of the Fed's reaction function about how it deals with its new average inflation target.
Great. And Kathy, did you see a change in the reaction function as part of that hawkish shift at the Fed then? Did you see that as consistent or slightly going against the dovish bias that we thought average inflation targeting was going to give to monetary policy?
It definitely raises some question about the credibility of the new framework. And as James said, it does give you some insight as to how different officials are looking at the average inflation target. Is it, and how far back is the look back period? So, is it, you find out from some of the regional Fed presidents that it seems to be quite short in nature. The Atlanta Fed President Bostic and St. Louis Fed President Bullard, suggesting that they could actually start to raise rates in 2022, even raising the idea maybe they raise rates before they even fully do the QE taper is quite striking, because the playbook all along was they would taper fully, then think about raising interest rates. But we got a lot of pushback, I think, from Chairman Powell and also New York Fed President Williams. And I even think Clarida, we haven't heard from Vice Chair Clarida since the meeting. But prior to that, he said that he still sounded dovish, but he was on alert for inflation. And I think that is a healthy way to look at things, because we really do not know how long the supply demand imbalance is going to last. And we all have been really rather surprised by how high inflation has gone most recently. So I think it's prudent. We weren't surprised that some of the dot plot estimates were moved forward to 2023, but in our view, 2022 seems a bit premature. And we think in the end, you follow the leaders, you follow Powell, you follow Williams and Clarida. And even if there's some dissension on the board, that's not surprising, given this is such a unique period of time.
So I'm interested then in that question of how much solace we take from the fact that the core members of the FOMC probably are lower dots than the median. And as is a common pattern, the regional Fed presidents are on the more hawkish side. I mean, is that really a good reason to think that the eventual realized rate path will be below the median dot? How much outsized say does the chair and the core of the committee actually have?
It's a great question. And it raises a couple questions on top of that. So I think one, I do think the core matter quite a bit. And we saw some regional Fed presidents get in line with them. San Francisco President Daly and also Cleveland Fed President Mester also lined up more in the dovish camp. But I think the data will really call the tune. I think the leaders muster a lot of control and leadership of the committee. But if inflation surprises to the upside, I think they will react accordingly. They're not going to be blind or passive. It's just that their view is this is largely transitory, and that they're willing to tolerate, they have a longer look back period. They're willing to tolerate a little higher inflation for longer. But I think it also raises this question. We've been asked by a few clients, do you think there's a risk that Powell would lose control of the FOMC? And I don't see that. We're not near that state right now, but it is something, marginally is a risk. My sense is you can certainly easily have two dissents, and that's not an issue. And then maybe it raises a question of how easy is it for him to be reappointed. He's done I think, a terrific job navigating through all of this very difficult period and crisis. But maybe President Biden gets some pressure from the more liberal Democrats to consider someone else. And it certainly, if he sounds a little bit more hawkish or joins the more hawkish camp, that could be an issue. If he stays more dovish, I'm not saying he would take that view to get reappointed, but then it may help his chances.
Yeah, the question of Powell's reappointment chances is an interesting one because, of course, there's this historical norm, which is that presidents reappoint Fed chairs even if they were appointed by the opposite party previously. And I think there was a lot of fretting when Trump broke that norm, and it would be interesting to see whether, in fact, he established a new norm, which Biden will then also stick to in changing the chair. But James, so let's talk a bit more about to what extent a more hawkish at the margin Fed has market implications. And in particular, are we moving from a sort of market regime that we might call reflationary, which was sort of pushed up break-evens, lowered real yields, weakened the dollar, was very, very good for equities, to a more challenging macro environment now that peak policy stimulus is sort of behind us and we're getting into the conversation about tapering and tightening? How problematic is that for financial markets?
I certainly think, and just observing financial markets since the meeting, there's been a pushback against maybe a bit of the creeping narrative that has started to come in around the Fed allowing inflation to just roll, this sense that the Fed had structurally changed and average inflation targeting would not just allow the moderate overshoot in inflation that was embedded within the guidance, but would allow a larger and more persistent overshoot in inflation. I think the way that the Fed is positioned, partly through some of the more hawkish dots, but I think also around Powell and the core's messaging around inflation. Powell was very clear that inflation is not transitory. Then the Fed has the tools and the willingness to take a stance against this. So I think some of the more outlandish expectations there have maybe been reined in to some extent. I'm still not completely convinced that this is sort of a setup for a very aggressively hawkish Fed in which they're very willing to radically bring the tapering timeline forward, shorten that timeline, absent some big surprises from their perspective on what inflation and growth is doing. Similarly, with regards to interest rate hikes, and I think I totally agree with Kathy that the data is going to determine this. And if we're right that a lot of these inflation pressures are transitory, then I think that it sets up the Fed to absolutely be looking to tighten in 2023, but not to sort of bring that further forward to 2022 or do anything too aggressive on that 2023 timeline. So, perhaps some of that open door to markets has been narrowed a little bit to some extent. Maybe there's some more active debate around degree of policy normalization, and that puts up a bit of a barrier to some of maybe the characteristics around some of those asset market discussions are different, and puts a little bit in the way of the discount rate for equities or the ability of the dollar to continue to weaken. That then can have its own knock-on effects, be it through international financial markets on other currencies too. But I guess I'm not saying that this will be something that sort of puts in a policy mistake style or a taper tantrum style that really shifts that quite aggressively. I still, hope that the Fed can tread this line, which is still relatively Goldilocks between removing policy support.
Yeah, one way that I like to come at that question is the rise in rates happening for the right or the wrong reasons? The wrong reasons would be some kind of stagflationary shock or a negative supply side shock. And perhaps you can make arguments that shortages in the labour market, problems we've talked about before on the podcast with the semiconductor market or the autos market in terms of supply, are those kind of wrong reasons. But it strikes me that the overriding reason, at least for a slightly more hawkish Fed, is the right reason, which is simply a very strong recovery, which justifies a higher rates complex. And my first take is, well, that's probably not a big headwind for financial markets. But Kathy, then maybe a final question. Can you lay out your expectations for the path of inflation and the Fed then? What are you actually forecasting at the moment? What do you think is going to happen?
Yeah, so I guess on the inflation front, we do think that we've probably peaked in terms of the year-on-year rate. So headline CPI is around 5%. The PCE, the price personal consumption expenditure price index, running a bit lower, around 4%. But we think as the base effects wane, that you're just naturally going to see a lower year-on-year rate. The key question, though, really will be those, monthly changes and quarterly changes, and if we get some easing and resolving of the supply-demand imbalances, whether it's on the labor front or the product front. We do think that happens, but it's going to take some time to play out, and probably is not to 2022 until we get some really good rebalancing there. So in the meantime, prints are probably going to be a little bit on the high side, but we don't think anything near, the 9/10, 8/10 increases we've just recently seen. In fact, used car prices, which have accounted for disproportionate increase of both the headline and core. Core was about 40% of the increase in core CPI. Used car prices have started to ease. And that is related to the global chip shortage that we're experiencing. So it will remain sticky, though, and I think that's going to be maybe a bit uncomfortable in the summer for investors and for the Fed Reserve, because it's going to make it a little difficult for them to really try to distill or assess whether inflation is really starting to ease back towards their 2% target. So a bit of stickiness, make things a little bit uncomfortable, I think, for everybody. In terms of the Fed, Paul, you asked me about that. Sorry. So we do think that they will start to do the QE taper. They'll announce that, we believe, in August at the Jackson Hole Symposium. And we think that they'll start to do the tapering early next year. And then by 2023, they tightened twice. And then thereafter, it's just very gradual. Now, our endpoint for the Fed funds rate is 1.8%. So that's lower than the 2.5% that the Fed has.
Brilliant. Kathy, James, thank you both very much. Well, that's about all we have time for this week. Thank you for listening to Macro Matters. Remember that we have a mailbox, macromatters@aberdeenstandard.com, and we'd love to hear from you if you have questions or topics or suggestions for the podcast. Don't forget to like or subscribe on your podcast platform. We're on Apple Podcasts, Spotify, SoundCloud, Google Podcasts, wherever you get your podcasts from. But until next time, goodbye and good luck out there.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.